important consideration is, for cash flow purposes, is tax. Unfortunately, if you're successful, the chances are that there's going to be some tax to pay, or there will be some tax to pay. So you need to plan for it, when they're due and the amount which is actually sort of due. If you're a sole trader, basically you pay your tax in 2 instalments on the 31st of January and the 31st of July. Just beware, there is a nasty little trap when you're self-employed, how the system works. You don't actually pay tax for quite some time when you're self-employed. But if you're doing quite well and you're profitable in year 1 or year 2, then there does tend to catch up with you, and you can almost have to pay 1.5 years worth of tax on the 31st of January. And it's knowing about that, so you do need to probably speak to an advisor so that they can just project forward your liabilities, because it's quite nice for quite some period of time you don't pay any tax, but it does catch up with you. If you're a limited company, then it's a little bit easier, the system. The limited company pays tax at 9 months after the end of the year, so it's quite straightforward in that scenario. If you're looking at sort of planning and everything else, the tax rates, if you're a sole trader, or being self-employed, or a member of a partnership or partner in a partnership, you pay income tax at 20%. There's also national insurance at 9%, so that's 29%. Contrast that to a limited company where you pay tax at 20%, so it's 9% lower. If your income's up over about £41,500, roughly speaking, under current sort of rates, and you're self-employed, then you pay tax. Income tax goes up to 40%. National insurance dips down to 2%, but that's 42% versus potentially 20% if you're a limited company. So you don't need to make too much money, and you could be into some very nasty tax liabilities if you're self-employed. So you do need to say, look, if I've started self-employed, when is the best time to change over to a limited company? And that's really where you do probably need to take a little bit of advice from an advisor as to the best time to move over. It can make quite a significant difference. I've done calculations and moved a lot of clients across who've been quite successful, and it saves them thousands of pounds, not on a one-off basis, but on an annual basis. Do speak regularly to your advisor. Do pre-year end sort of meetings so people can project forward your liabilities, so you're not left in the situation where someone comes to you and says, here's your tax return, by the way, you've got a big tax bill to pay in 1 week's time. Do have a meeting or a conversation with your advisor a month or 2 before the year end. You can then affect any changes you need to do before the year end to save some tax, and also you will then know how much tax will be due within reason, and when it'll be due, when it's actually due. My experience, it's quite an important conversation to have.